Hi everyone. As you know from the title, the aim is to outline 12 differences between LIBOR, which has been the main benchmark for interest rates like S&P 500 and FTSE 100 are for stocks, and the new RFRs, which are going to replace the LIBOR. These go by several names, nearly risk-free rates, alternative reference rates, and include the kind of SOFR, SONIA, and STR, etc. Let's start with the easy ones. LIBOR represents the wholesale unsecured funding cost of major banks for certain tenors. So if a major bank wants to borrow for 1 day, the overnight rate is the estimate of the cost it pays. And if it wants to borrow for 1 year, then it pays something close to the 1-year rate. By the way, for some currencies, the overnight is replaced by spot next. The main thing is LIBOR is published for a set of tenors. The RFRs, on the other hand, are published for just one tenor, the overnight tenor. There are certainly transactions for longer tenors in the markets that the RFRs represent, but the liquidity is usually concentrated in the short end, so reliable and robust estimates of interest rates can only be produced for the single overnight tenor. Which brings us to the second key difference. LIBOR uses a waterfall methodology. As you know, LIBOR is an average of the rates provided by a panel of banks. Each bank is encouraged to base the submission on a volume-weighted average of actual transactions, but if there are not enough transactions, then its submission can be based on its judgment as to the rate at which it can access the market. There are usually not enough transactions though, because the wholesale markets has been very quiet, particularly beyond the overnight tenor, so the use of judgment is inevitable. The pride and joy of RFRs, on the other hand, is the transactions in active markets. Please do note that many of the RFRs will have contingency plans in place in case there is some market disruption of some sort and they can't calculate the rate. For example, if SONIA can't be calculated, the contingency plan is to take the bank rate as the base, then take the spread between the SONIA and the bank rate over the past 5 days, discard the minimum and maximum of the 5 spreads, and then average the remaining 3. Add this average spread to the bank rate and you have the SONIA rate for the day. STR has a similar but more involved mechanism. SARON is a slightly different story and its contingency plan is quite simplistic. You just go with the previous observation. The main point, however, is that these contingency calculations are to be used in exceptional circumstances and not on a BAU basis, whereas LIBOR calculations use judgment and approximation as a matter of course. LIBOR, for all its flaws, has one good thing. It's calculated on a more or less consistent basis across currencies. For all currencies, it represents the cost of wholesale unsecured funding. RFRs, on the other hand, can be unsecured, which is the case for SONIA and STR, or secured, which is the case for the USD SOFR and the Canadian CORRA. The consistency is not easy to achieve considering the differences in markets. For example, for the USD, they could have used the current main overnight index, effective federal fund rate, which is unsecured, but the quantitative easing and the payment of interest on excess reserves have actually diminished the markets. So far, which is based on repo transaction, is a better choice in terms of market activity. Pound sterling index could have used the repo index, but it didn't for 2 reasons mainly. There is already a derivative market around SONIA, and repo market is not much larger, and it also generally shows idiosyncratic behavior around the quarter end dates. That's when the institutions try to make their balance sheets look pretty for the beauty contest. So SONIA seems a better option. In Europe, you can see repo could be problematic simply because there's so much variation in the credit worthiness of the countries making up the union. Another positive for LIBOR, the LIBOR panel banks provide the estimate of funding cost, assuming minimum transaction size of 10 million across currencies, apart from yen of course, for which the minimum size is 100 times larger. However, there's variation in the minimum transaction sizes across the different RFRs. SONIA, for example, exclude transactions below 25 million, STR below 1 million, huge variation there. And if you happen to know the minimum size of transaction that go into the calculation of SOFR, then do let us know. Another devil in the details type difference is the timing. LIBOR aims to provide estimate of borrowing cost as at 11 a.m. London time. RFRs, on the other hand, are based on average over the whole day or substantial part of the day anyways. SONIA, for example, is based on transaction executed between midnight and 6 p.m. this 18 hours. SARON is a slightly different story. It uses a combination of actual transaction and quotes and is continually updated every 10 minutes, but the last fixing at 6 p.m. is what makes the SARON RFR. LIBOR is a trim average. Say 16 banks provided the following estimates. You will order the submitted rates in ascending order. Discard the bottom 4 and the top 4 and then average the rest. The reason for the trimming is to ensure that the rates doesn't get influenced too much by the outlier, so it kinda reduces the risk of manipulation. It's a trim simple average of individual bank submissions, though each bank submission can be based on volume weighted average with more weighting to transactions around 11 a.m. So it is a trim simple average of a weighted average at best. The RFRs, on the other hand, are trim volume weighted averages or median in the case of USD SOFR and Canadian CORRA. For SONIA and STR, for example, you will take the volume of transactions by the rate, discard the bottom 25% and the top 25%, and then calculate the volume weighted average, and this the RFR. USD guys do it differently. They discard the bottom 25% and then compute the volume weighted median of the rest. The reason they discard the bottom 25% is because SOFR is based on repo markets, which can include the specials. These are the repo against securities that are highly desirable, so people are willing to charge lower rate for lending against these securities. The lower rate on these reflect their desirability as opposed to lending borrowing conditions, so the exclusion of the bottom 25% is aimed to remove such transactions. And the reason they use volume weighted median is to do with the fact that the current OIS index, the effective federal fund rate, is calculated using volume weighted median. They switched to median a while ago, and the reason they switched had to do with the fact that in times of crisis, the mean is affected by the outliers, whereas the median produces a result that's close to the point where most of the transactions lie. Anyways, some people think that the use of median in the heterogeneous repo market can lead to jumps in the rates, particularly if the markets intersect around the 50% volume mark, but they chose median nevertheless. Another easy one. LIBOR is published to 5 decimal places, whereas for RFRs the precision varies. STR is rounded to 3 decimal places. SONIA is rounded to 4 decimal places. SARON to 6 decimal places, and if you happen to know what the SOFR guys do, then do let us know. Next is an easy one, but has profound implications for the design of financial instruments, and that's the reason the length of this video is long, as we shall see. LIBOR tells us the borrowing cost in advance. When we see the overnight GPP LIBOR, say on the 18th, it means we can borrow the money today at this rate and repay it tomorrow. On the other hand, SONIA is published in arrears, so the SONIA rate that gets published on the 18th will be the average rate on transactions that were settled yesterday and which will mature today. Now let's say we have the 1 week LIBOR as of the 6th. Assume the spot date, this when we get the money, is the same as the fixing date. Remember, 5 decimal places, so this is the LIBOR rate to 5 decimal places. Let's bring in the calendar so that we can count. 1 week means we will need to return the money a week later, which is the 13th. And we know money markets use simple interest rate conventions, so to calculate the interest rate for 7 days, we just multiply the rate by 7 and divide by 365. and then apply it to the notional. The main point is we knew the reference interest rate for the term of borrowing at the time of borrowing. And the RFR world, on the other hand, as we saw earlier, the rate is published every business day in arrears. So in its natural state, we won't know the rate we are going to end up paying, but we'll get to know the rate for 1 day at a time. Starting with the 6th, we will get to know the charge for the 6th on the next business day, which is the 9th. The rate applies for 3 calendar days. Then we find the cost for the 9th to 10th on the 10th. It applies for 1 calendar day. We then do the same for the next day, and so forth until the 12th, which we find out on the 13th, which is the day we are supposed to repay the debt. Doesn't give us much time to process the payment because we get to know the rate on the 13th and we are supposed to make payment on the 13th as well. Now the rate is annualized, so we need to multiply it by the time fraction. For GBP, we get the fraction by dividing the number of actual calendar days by 365. For USD and Euro and many other currencies, the convention is to divide by 360. We do the same for the rest of the days, and we then just multiply the annualized interest rate for each day by the respective time fraction. Now the interest accrues daily but is repaid at the end, so we will need to aggregate the interest amount. The most natural thing would be to assume compounding of interest, so let's add 1 to each rate so that we can compound. It's better to write it in symbols so that we can generalize. Each daily interest entry is of this form: 1 plus rate times the time fraction. So we multiply the daily entries, where NB is the number of business days in the period. Here it equals 5, which is the number of working days in the week from 6th to the 13th. This is now the amount we need to repay. It includes the principal amount 1. So if we subtract 1, we will get the interest amount. So this is the equivalent of the interest amount we calculated for LIBOR. And if we multiply this amount by 365 divided by 7, 7 being the number of calendar days, then we recover the interest rate. So here we go. By the way, one can simplify the calculation of the compounding rate by creating an index. So the index will grow each day by 1 plus the rate times the time fraction, and generating the interest rate for a bespoke period will then just be as easy as calculating the return on the index over the relevant period. Now this compounding is quite natural and make economic sense considering the market conventions, but many people won't worry about compounding, especially for a short tenor. So one might as well say, let's calculate the interest amount using a simple sum of the daily interest amounts, and multiplying this by 365 divided by the number of days will give us the interest rate. So this is an alternative way to calculate the term rate from daily overnight rates. Notice it is a simple average over calendar days, but since we are using the business days index, we have to use calendar days as weights. For example, 2 consecutive working days are 1 day apart in terms of calendar days, but Friday and Monday are 3 days apart. So this is the reason we have the rates weighted by the DIs. Now let's discuss the impact of the differences on the financial instruments. Let's start with the futures. Say you're expecting some cash in March 2021, which you would like to invest for 3 months until June 21. Now the rate you're going to get in March 21 can be anything. It's uncertain, but if you like certainty and would like to fix the rate, then one way to do so is via 3 months future contract. The future contract will involve those daily margining, and one also need to know the details such as the contract size, etc. But let's assume we are not worried about those things. Let's bring in the calendar so that we can count. Now the LIBOR future contract settles on the 3rd Wednesday of the contract month, which is the 17th for the March contract, as you can see. And the settlement amount will be based on the then 3 months LIBOR. If the currency were to be GBP, then the LIBOR rate for the period starting on the 17th will be published on the 17th. For USD and Euro, etc., the rate will actually be known 2 days ahead of the start of the period, which is Monday. The 3-month LIBOR will of course cover the 3 months from then, so to calculate the end date, you just advance the date by 3 months, which falls on a working day, so we don't have to do the modified following type calculations. The 3 months LIBOR with settlement on the 17th covers 92 calendar days because, as you can see, March and May have 31 days each, which is 62 days, and then April has 30 days, so we have 92 days. This period of interest that the future contracts refers to, this is the period from March to June here, is called the reference period, and this is the length of time that the LIBOR that the future contract settles into covers. The main thing is the interest rate is fixed at the start of the reference period, so the trading stops there. Now let's see how an equivalent instrument in the RFR will look like. Let's say we have the same delivery month, March 21, so the reference period starts on the 3rd Wednesday, which we saw is the 17th of March. It covers the period to the next IMM date, which is the 3rd Wednesday of June, which is on the 16th of June, so the number of days is not 92. By the way, the reference period goes from the 17th to 1 day before the next IMM date. Can you see why? The main difference, however, is that the interest rate for the reference period will be revealed 1 day at a time, so the contract will stay alive until the end of the reference period, and the interest rate that it settles into will just be the compounded average that we saw earlier. Here, NB is the number of business days in the reference quarter, and N_C is the number of calendar days. And by the way, the monthly future contracts on some of the exchanges use the simple interest calculation approach in contrast to the compounding. EDSP means exchange delivery settlement price, and the future price will just be 100 minus this price. This is similar to how the LIBOR futures are quoted, so EDSP is the RFR equivalent of the LIBOR. And do you know why futures are quoted in this weird way? It's because when the futures on interest rates were launched, the IG system couldn't handle them because the design never anticipated that there would be contracts on rates themselves. So this was an ingenious solution to expedite the development of future contracts on rates. Let's move to swaps then. Consider a quarterly USD LIBOR swap with 1 year maturity. Let's say we are trading this swap on the 16th. The common settlement period for USD is 2 days, so that's when the accrual starts. We will have 4 cash flow periods, and the start and end dates are easy to calculate. Now the floating leg of this swap will be linked to the LIBOR. The LIBOR rate that applies to each of the periods will be fixed at the beginning of the period, actually 2 days before the start date because it's USD. So for each quarterly cash flows, we will know 3 months in advance how much are we going to pay, and the fixed lag is also known, so we will have no problem exchanging the net cash flows on the respective end dates. Now let's say we have the same swap except the floating lag is tied to SOFR. SOFR we know is an overnight rate, so we won't know how much the floating lag is going to pay until the end of the relevant period. Once we have observed SOFR over the period, then calculating the floating rate is just a matter of plugging values in the compounding formula we saw earlier, or in some cases you will see the simple interest formula with no compounding. Irrespective of the compounding method we choose, the main problem is the last observation of SOFR will only be known a day after the period end date, so we will need to allow some time for the counterparties to process the payments. 2 days has been the common standard in the OIS markets, and that's it. We can see the differences between the LIBOR swap and the RFR swaps, and it makes sense. RFR swaps involve just a little bit more work, and one has to be patient. Now here is the rub. The standard RFR swap we just discussed was developed in a world in which the OIS swaps were only playing a secondary role because LIBOR was doing the heavy lifting. When the underlying market switched to RFR and LIBOR disappears, then the swaps conventions will have to evolve to enable hedging and risk management of underlying positions. As we shall see shortly, For hedging loans in cash products, the RFR swaps might have to develop lookback features, for example. Now let's consider floating rate note, which you might know as FRN. The LIBOR FRN is similar to the floating leg of the swap, except that we get the notional amount at the beginning and repay it at the maturity. The flows will be the other way around if we were lending. The interest payment for each coupon period will be LIBOR plus some spread, and the LIBOR rate that applies to each of the periods will be fixed at the beginning of the period. RFR, on the other hand, we expect will involve a bit more work. One can't know the applicable rate until the end of the period, so one has to come up with an alternative solution. One option, just like the swap example we saw, is to make the interest payment with a delay of a few days. It's not ideal, but paying interest a couple of days late is not going to have a massive impact. Notice the principal or notional can be repaid at the end date because it's known at the very beginning of the contract, so no need to delay the principal repayment. Also, delaying principal repayment will have more impact on the interest amount, so one can pay principal at the maturity date and interest with a few days delay, but then some people won't like processing too many payments. It's a recipe for errors, isn't it? There are several alternatives one can use, and these alternatives reveal themselves when one focuses on the multiplicative component of the formula. One option is to use the lag values of the overnight rate. So one will know the amount of interest few days before the end of the period, and hence the payment can be made on the end date. This amounts to lagging the values of S by a fixed number of 2 to 7 days. 5 seems to be becoming the standard, and the method is known as lookback. Notice 5 business days means a whole week. Now this is quite easy to calculate, but from economics viewpoint it's quite messy because the rate and day fractions are not aligned. Alternatively, one can shift the day fractions as well, and now we have a shifted version of the lookback. This version could be even more problematic. For example, if the lag observation happens to be just before a long holiday period and the actual interest period covers only one calendar day, or the other way around. For longer periods with 5 days look back is probably not going to make a huge difference, but for shorter periods the impact could be quite material, and the look back without the observation seems to be winning as things stand. Visually, if this line were to represent the interest period, then under the look back, the rate we are using is actually from a shifted period. So day count is coming from the observation period, and the interest rate that it gets multiplied by is from a shifted window. And the look back with the observation shift, both the interest rate and the day count are from the shifted window. Alternatively, one can use a truncated window, essentially truncate the SOFR observations period. So instead of compounding over n days, we compound over n minus, say, 5 days. When annualizing the rate, we will have to change the denominator to reflect the reduced number of days that the interest rate has been compounded over. And if you don't like this messy denominator, then there's another method called lockout, which is popular in the US. So you compound as you would, but for the last few days, you freeze the rate. So essentially, you compound the rate over the number of business days and the relevant period minus, say, 5 business days. For the last 5 days, you use the SOFR rate that was observed on the last day of the truncated period. You then don't have to change the denominator, but again, it's economically messy. Imagine if the interest rate on the day you freeze the rate happened to be too high or too low. Each method introduces some sort of complexity, and the complexity is the price for certainty. We want to know the future rate in advance so that we can process the payments on time, and to know the unknowns means some sort of complexity is inevitable. And if one doesn't want complexity at all, then the rate could be fixed at the price of the spot starting OIS swaps. So at the start of each interest period, you enter a spot starting OIS swap, paying fixed, receiving compounded RFR and arrears. The price of these swaps will be known at the beginning, so you will know the net rate. This sounds simple but will involve transaction cost. Derivatives don't come cheap, even though we see martingales everywhere. And remember, we said earlier the swaps will probably have to evolve, and in that regard here we see a need for an OIS swap with lookback or lockout options. This is because swaps and other derivatives are used for hedging loans and cash products, so one expects there will be demand for derivative products that reflect the interest calculations of the cash products. I hope for us the forward rate agreements, caps and floors and swaptions are now easy to compare because they're very similar to what we discussed, so I'm going to leave them as an exercise. Please give a thumbs up if you would like to see similar videos, and I look forward to seeing you in the next.